Hello trade pros. In today's video, I'm really excited to give you a sneak peek of our futures trading course. I'm going to provide you a snippet of the entire futures course lesson 1. In here, you're going to learn a lot about what futures are and some of the benefits they carry over currencies, options, and stocks, and how you could use that benefit to your advantage to make more money with a smaller account. Let's jump right into it. Lesson 1, what are futures? Everything you need to know about futures. This is more of the basics. And then we don't have too much time to spend with the basics. We go right into reading order flow, lesson 2 tomorrow. You're going to love this one. You're going to love all of them, but this one's really good. Reading order flow will kind of open your eyes, have some real practical exercises that you're going to be able to do, and I'm going to need some volunteers to help you participate in lesson 2 to solidify these concepts. So that's tomorrow. Then next Tuesday, we're going to look at volume profile, what it is, how it works, different types of opening days, what a volume profile indicates for support, what it indicates for resistance, how to put your stops based on a volume profile, how to set targets. There's a ton of stuff. All right, lesson 4, finding trading zones. This is going to start to accumulate some of the knowledge you already got, volume profile, order flow, and you're going to start to put these two together on how to find trading zones and hone entries. Lesson 5 is going to be intermarket relationships. All right, this is a super important lesson. This is how to find a market that correlates with the one that you trade and how to allow it to do the work for you, to let you know when's a good time to get in and when it's not, to let you know when you may want to avoid a trade, and to let you know when another one might work before it even happens. This is intermarket relationships, probably one of the more important lessons. Actually, they all are. All right, lesson 6, we're going to talk about trade entry strategies, how you could get into trades. So you're going to come in here and build a hypothesis based on your analysis on trading zones, volume profile, order flow, intermarket relationships. You're going to say, hey, I got an entry strategy. You're going to build a hypothesis. I want to get long or short. You're going to have a bias by this point. You're going to be able to tell which way you think it's going to go or where you think it's going to head, more importantly. And then on here, okay, what are some entry strategies? You want to get long? How do you get long? How do you pick a location? This is like real estate. We're going to pick locations. It's all about location. That's trade entry strategies on lesson 6. Lesson 7 is risk management and exit. Okay, risk management and exit strategies on how to get in, how to manage your risk, how to lose less, and how to focus on cutting losses. Forget about making these massive returns everybody wants. They're not important. It's more important for you to lose less. Once you lose less, you're going to make more by virtue of obviously keeping more of the capital in your account where it belongs. Okay, that's what we're going to talk about, risk management, exit strategies. Lesson 8, 9, and 10 is going to be live trading days. Here's what we're going to learn today. All right, what are futures? We're going to look at contracts, what a contract is, how it's formed, specs. All right, we're going to talk about that as leverage, how to get leverage, the power of futures, margin. Price ladder techniques is tomorrow. Of course, we're going to explain price ladder. If you pay for a futures course and there's no price ladder techniques or an explanation of how to use a price ladder, how to work the dome, it's called depth of market, you ought to ask for your money back. We're going to look at it. Tomorrow we're going to talk. That's all we're going to focus on pretty much, order flow. It's the dome, how to work it, what it means to throw resting bids, what it means to be an aggressive bidder, aggressive seller. I'm going to quote the market really fast for you guys. I'm going to work the ladder and you guys tell me sold or bought whenever you're ready. All right, so it's going to be fun. And I have an exercise for you guys as well for tomorrow. So yes, we're going to get into a lot more depth tomorrow. This is just today's introduction on what futures contracts are. Who are the participants in the market? It always baffles me how so many traders are out there, but nobody knows who they're trading against. What the heck's the point of competing against somebody if you don't know who they are? So you got to know who the competition is and what their bias is and what they trade futures for, more importantly. And we're going to look at commitment to trader reports and how to use them. Very, very important tool for helping you plan the week before. So we're going to look at these. Today, we're going to look at brokers, FCMs, and data sources for you, and then platforms and software. That's all today. Today. And by the end of this, you're going to walk away with a cutting-edge software with a 14-day free trial and my pack files. I want to talk about that. All right. Also, we're going to cover news sources for professional traders and how you too could get access to them for a discounted rate. You won't need it right away, but if you're going to do this professionally, start to make money off of it, you do definitely need a news wire. and I'll talk to you about it. It's nowhere near the money you're thinking. All right, so what are futures? This is the first concept you guys need to understand. The word futures, if anyone's ever scratching their head, it's because it's based on something in the future. It's a contractual obligation that's based on a future price. All right, so to define it more clearly, a futures contract is contractual obligation between a buyer and a seller for a commodity or asset on future price. All right, and there's a big difference between futures and options. How many of you have traded options before? Does anyone ever trade options? Yes. All right, we got a lot of options traders here. There's a difference. All right, the difference is that options are an option. That's all. It's simple. You have the option to do something, whereas a futures contract is an obligation as a buyer and as a seller. If you own or you sell or you transact in futures, you are automatically obligated to take some course of action in the future. And here's the unique concept. An option as a buyer, okay, gives you the option to purchase at a specified price before a specified date. A futures contract gives you the obligation. So the number one thing I want you guys right now to beat in your head is never, all right, never, like I mean ever, let a futures contract expire. If the expiry date is the third Friday of the month, you better make freaking sure you're out of that the second Friday of the month. All right? So never hold on to a futures contract. It'll cost you, and it could cost you big. All right? That's step number one. So basically what this means is there's a finite shelf life for this futures contract, and your goal is to trade it to make some money off of it, hot potato, and by the expiry date, be out. Okay? It's something like 99% of futures expire by people closing them out. Even hedgers, even speculators, we'll talk about that later on. Right? That's the difference between an options contract and a futures contract. You are obligated on expiry to either take delivery of the asset or to sell the asset. All right? So basically, what does that mean? Let me just back it up a second. Let's say we are trading, it doesn't have to be S&P 500 futures. Let's say we're trading corn. All right? And let's say Johnny over here thinks corn is going to go up. And the farmer says, you know what? I got a ton of corn to sell. I want to fix my futures price. I want to say, let's say corn's at $5 right now. And the farmer says, you know what, 6 months from now, all I want to do is be able to sell it at $5. I just want to fix or guarantee my production costs so I can produce this stuff and know what I'm going to pay, know my profits ahead of time, and smooth out my operations. So the farmer's just a businessman. He doesn't care to speculate. Johnny over here thinks corn's going to go up. So this transaction is made between the two of them on the future price. Johnny is the buyer, all right? And the farmer here is the seller of the futures contract. Well, guys, some real interesting stuff happens here. The farmer has product. Johnny's got cash. And let's assume that on expiry date, 6 months later, the price is trading at exactly $5. What happens? Well, I told you, the number one important thing is never hold a futures contract to expiry. Johnny's going to get a notice to take delivery on bushels. Depending on how much it is, it could be thousands to hundreds of thousands of dollars, depending on how many contracts you hold. Because what happens is the farmer has to sell his crop, and you're buying it right from him. So they're not going to dump a truckload of corn on your lawn, but they're going to say, your corn, you have $100,000 worth of corn being held for you at XYZ storage facility. Come and get it. All right? That's the difference between futures. There are obligations. Number one thing you need to write down on your piece of paper is don't hold the contract until expiry unless you want 1,000 barrels of oil physically. All right? There's physical exchange here. All right. Now, for electronic trading, it's conducted through the CME, the Chicago Mercantile Exchange. It's centralized and guaranteed. What does that mean? It means that if Johnny doesn't know the farmer, and the farmer says, you know what, Johnny, I know I sold you all these bushels of corn, but I don't have that corn. My crop was devastated in the winter. Whatever the case might be, I can't give you the corn. Because it's centralized and guaranteed, it doesn't matter if the farmer bankrupts or defaults, Johnny will get that corn from elsewhere. And it's centralized on an exchange. These contracts are guaranteed, so nobody's going to get ripped off. It's a contract that's guaranteed to perform. All right, any questions so far? Because, you know, this stuff, it's all like, yeah, this is all easy peasy. Show me how to make $1 million until you get caught short 10 contracts of oil and you owe 10,000 barrels. and they're saying, where can I get it? I'm looking for delivery. It's all fun and games until one of these days you get nailed onto this stuff. And I got stories for you guys of people that have done that. Obviously, you don't take physical delivery. Somebody says, like I said, they don't dump the corn on your lawn, but it's being held for you. For every futures contract, there's an actual asset physically being held that's going to be transacted, except the S&P 500 futures, and we'll talk about those in a second. All right, different products have their own contract specifications. These are called contract specs. You don't have to know them all unless you plan to trade them. All right, there's corn, there's butter, there's milk, there's softs, there's orange juice futures. Heck, there's futures on anything you can imagine. Anything that's commoditized or that has use in the production of anything else has a contract back to it in the futures market. Do I know the corn specs? No, not really. Who cares about corn specs? I've never traded them, nor do I ever plan to. Who knows? Maybe there's a good trade, I'll take it. But what I'm saying here is it's not like you have Apple, for example. Apple, and they have 100 shares, and Google has 100 shares. Yeah, these are shares of two stock companies. In the futures market, it doesn't work like that. You can't compare oil to, for example, gold. Each one of these contracts is different. It's like X and Y. You can't compare them. So remember that. If you're planning to trade a specific commodity, you got to know its contract specs before you get out there and start trading, because you get nailed for it. This is what they mean by contract specs. Specifications, basically. All right, we're going to focus on two contracts for the majority of this, potentially three, and they're very similar, is the S&P 500 index futures and crude oil. All right, those are the predominant two that are traded. The index futures on the S&P 500, it's called the E-mini contract. This is one of the most liquid, most heavily traded contracts in the entire world. All right, and I'll show you why in a second. Crude oil, the same deal here as well. All right, so these are the two most liquid contracts, E-minis and crude oil. And if you think about it, there's a clear purpose as to why. I'll show you that in a minute. Let's look at some contract specs. How's everyone doing? Are we moving too quick? No? Good. Got a ton more stuff to cover. Look, the goal of this course is to start not knowing much about futures and to be able to trade them. First lesson's more of the basics, but we're going to dive right in, and you're going to see. We're going to turn up the heat here. All right, here's the S&P 500 index contract specifications. Is there a workbook? Not for this course yet. I'm going to see what kind of questions you guys ask and then create one. There's going to be a lot of exercises, though, and a lot more of a live component here. We're going to do one in just a minute, actually. Okay, so S&P 500 index, this is called the ES or the E-mini. The contract unit, that's the name. All right, the minimum price fluctuation, this tells you what is the minimum amount that it could change. Basically, the way that this is priced is the index, all right, times 50. Times 50. And I'll show you that in a second. I'll take you to the website. I'll take you straight to the source. So if the S&P 500 is trading for $2,000, it's $2,000 times $50. That's your notional value. For every, the way the contract moves, a tick is the minimum amount of movement that could occur incrementally up or down. Every one tick is a quarter of a point on the S&P 500. So if the S&P 500 goes up 1 point, how many ticks is there in 1 point on the futures contract? Let's see, the S&P 500 index goes up 1 point. How many ticks? 4. Exactly, 4 ticks. Now, because every 1 point on the actual index is equal to $50, how much is 1 tick worth? All right, 1 tick is worth $12.50. So for every 1 point that the S&P 500 goes up or down, you make either $50 or you lose $50 per contract that you own. Very important to know that. Okay, you should know that. You should know what a tick size is for any instrument that you trade. All right, trading hours, this is where it gets exciting. The S&P 500 futures trade around the clock, essentially. All right, from Sunday night, they open at 6 p.m. Eastern time. You're saying, who the heck trades them? I'll tell you who, Asia. Asian sessions start to open up. Actually, Asian session opens up a little bit later. What's it called? before that. Oh, sorry, missed the words. Another session opens up and then rolls into Asia, and that rolls into Europe. So basically from Sunday at 6 p.m. all the way until when? Until 5 p.m. of the following day. All right, think about this. Here's how the contracts trade. Sunday, it opens at 6 p.m. Based on these futures, you could see what the price of the S&P 500 is trading at. When you go in the financial press and it's 9 p.m. and they say equity markets are down 10 points, what they're quoting you is the futures price. All right, because these futures trade around the clock. The only time they close is 4:15 to 4:30 p.m. Eastern time. Okay, it's the S&P 500. They close for a 15-minute break. And then they actually close they reopen from 4:30 to 5 p.m. Not sure why, but hey, I've never traded in that time slot. Close trades there, but I've never traded in that time slot. And then they close again from 5 to 6 p.m. And they reopen 6 p.m. for the next day, and it just rotates through the schedule. All right, so it basically means, let me ask you guys a question, see if you're paying attention. Right now, what day is it today? It's Wednesday, all right? Let's say it's Wednesday today. Is it Wednesday or Tuesday? I don't even know. It's Tuesday. It's Tuesday right now, and the time, let's say, is 4:29 p.m. Can I sell my futures contracts? I own 5. I want to dump them. Can I sell them? No, exactly. Locked out. All right, 4:31. Can I sell them? Here's a question. I got 1,000 contracts. I'm long 1,000 S&P 500 contracts. Can I sell them at 4:31 p.m.? Does it make a difference if I got 1,000 or 50? What do you guys think? Look, it's obviously going to be easier to sell the 50 than the 1,000. So despite the market being open, exactly, that's the key. If there are buyers, if somebody willing to buy your stuff, you could always sell it. All right? So just because it's open, it doesn't mean you have to trade or that you can trade. There's still liquidity you got to look after. And I'll teach you how to decide if liquidity is worth even trading by looking at a price ladder tomorrow. So there it is. What happens? You guys know what happens at 4:15 p.m.? This is what's known as the cash close. Actually, the cash close in the U.S. technically happens at 4 p.m. Eastern time. At 4 p.m. Eastern, this is what's known as the cash close of the U.S. session. It's when the trading stops. Okay, and then it goes into pit. Cash and pit is the two different trading floors. We'll talk about that in a moment. Let's not confuse things. What ends up happening at 4 p.m. is margin increases. You guys know why 3 to 4 p.m. is the single-handedly most active hour of the S&P 500 futures. About 20% of the volume to 30% of the daily volume could trade in this 1 hour time frame. The reason being is at 4 p.m. the cash close happens and something really important takes place. We'll talk about that in a second. Let me bring you to the CME website, but before we do that, here's how these contracts are listed. Remember we said the future price is what these contracts are based on. So we're trading a contract that will expire at a future price that we don't know. Well, look at this. What are the future contracts listed on in 4-month increments, and they're tied to the calendar quarters. So we have March, June, September, and December contract. Right now we're trading the DEES. All right, so we're trading the DEES contract. This is listed as a Z on a lot of platforms. And what you want to do is know what contract period we're in. On the third Friday, that's when futures expire of the month. That's the expiry date, and all long holders and short holders have to transact. And I'll tell you how that works in a minute. Okay? So the second week, write this down in your notes. The second week, the second Thursday of the month that it expires, so in December, the second week. So next Thursday, we roll from the current month to the next one. So we're going into what month? What's the next futures contract we're going to trade after next Friday? Guys, the expiry is on the 16th. So on the 9th, what are we switching to? Not Jan, because there isn't a Jan. Right? We're going to March. March, June, September, December. And then second Friday of March, we flip to June, and then September, and blah, blah, blah. Yeah, exactly. So that's what you need to know. That's how they're listed. Now, let me take you to the website and show you where to find this stuff. If you go to cmegroup.com, that's going to be your home base while you learn this stuff. Go under Trading, Equity Index, click it here. You can find the full contract specs of anything you want to trade. All right, here's the S&P E-mini 500 futures. The E-mini means that it's a 50 denomination. All right, make sure you're trading the E-mini or following the E-mini, because if you go to the S&P 500 futures, these are called the big futures. The big futures because each contract is $250 per point. All right, the big futures means if it goes up $1, it goes up $2.50 in value. Small contract, $1 is how much? 50. Or sorry, 1 point in the S&P. 1 point, not dollar. 1 point in the S&P is $250 on the big one and 50 on the E-mini. I'll tell you something right now. If somebody wants to dump 500 S&P 500 contracts, you guys think they sell 2 large ones, or do you think they sell 10 small minis? What do you think? 2 or 10? Yeah, they're going to dump the small. They're always dumping smalls. No trader is going to dump these big ones unless there's some good liquidity. There really isn't. The pits used to trade this contract. The big one is where the pit started, and then the mini broke out, and that came on the Globex or the electronic session. So when these floor guys were bidding 10, 20, 30 contracts, they were the big boy ones, not the E-minis. All right. Here's, is this Eastern? Yeah. So here's the trading hours for that contract. That's the major one. Let's go back to the E-minis. That's the one we always want to focus on. So you just click on E-minis, and honestly, guys, you could find, I'll put this link up on our website. You could find anything you want here. You can find the contracts. You click on contract specs up here, for example. You can see what I was talking about, 50 times the point, the trading hours. All right, financially settled. Let me tell you what that means. Okay, so when does the December contract expire? Who wants to contribute the date? December 16th, exactly. That's the settlement. You can see that here. Settlement, December 16th for that contract. All right, so knowing that information, knowing December 16th, what do you think happens on December 16th if we're trading at 2200, let's say, even, and you have one contract? If you're long one contract, what do you think that means? Does that mean that you have to go out and buy? What is the futures on the S&P 500? Ask yourself that. Let's say you have 500 companies to trade on the U.S. That's the S&P 500, some of the bigger names. All right, so if you hold one contract, does that mean that you have to buy 500 companies? Does that mean you have to buy one share in each company? Yes or no? What ends up happening on assignment or on contract expiry? No, you don't. This is all cash settled. Cash settled. All that means is you're going to settle in the cash value that you are trading, if you're selling or you're buying. Basically, it's not a massive deal for the S&P 500 to trade through this expiry, because all that happens is whatever loss you have or gain, it becomes realized instead of unrealized. It's not a big deal, but always train yourself to not get left in that situation, because in a few minutes when we talk about oil, heaven forbid you find yourself in a short option or in a short futures or long futures position on expiry. It becomes a pain. It's not a massive pain, but it's a pain that you have to deal with. So on the S&P 500, not that big of a deal because it settles in cash. So they're not going to have to take any physical assignment of anything. It's a bit of a safer contract. All right? Any questions so far? You guys get it? I know it's a lot of info, but you need to know what you're trading. It's kind of like going to the market to buy something. You know what you're buying, but you're trying to make money off of it. It ain't going to work. So what we talked about was $12.50 per point. They settle in cash on the expiry date. They're quarterly. All right. We know that much: March, June, September, December, the third Friday of the contract month. But we don't really care because we're going to get out the second Thursday instead of Friday. Second Thursday, we're going to switch and roll to the next month or the next expiry date. So it'll happen in March, June, September, December. What happens with gold? Well, look at this. So that's a good question. So if we go under in here and say go to metals under CME. All right, and then you find GC. This is your gold futures contract. And look, deliverable. So for every one contract that you are short or long, let's say you're long gold, 100 troy ounces, you're long one contract of gold futures. For every one that you have on the settlement date, you now have to buy 100 ounces of gold from somebody, the counterparty that you just did a transaction with. Because remember, you're the buyer, there's a seller. If you're long one futures contract, somebody sold it to you in order for that transaction to happen. So whoever sold it to you, some of them might have bought back to close their position. If you're still short on expiry and you're still long on expiry, these two traders match, and physical commodity is exchanged on gold. So it's deliverable. All right, so basically don't get caught in that. You know, we might trade gold occasionally too, so it's not a bad contract to review very quickly. 10 cents is the minimum price fluctuation per ounce. All right, let's move on to the next one I want to talk about. I want to talk about oil. All right, so if you go trading energy, are you guys learning stuff so far, or is it just a review? Even if it's just a review, better know this stuff. I'll give you an example with the guy with oil. So when I traded on the desk, I traded stocks and options, did not trade futures at the time, but I had a friend that did. Let's call this guy friend A. And A had a client who ended up with 3 contracts of oil. They sold most of them. They had 3. There was a miscommunication, how they ended up with 3, whatever. And on the expiry date, having 3 oil contracts means what? Look, each contract puts you in an obligation to transact 1,000 barrels. So what do you think happened? My friend's client ended up holding 3 contracts. Well, he was long 3. So does he have to buy or sell oil if you're long 3? You've got to buy. All right, so he's got to buy 3 contracts times 1,000. He had to buy 3,000 barrels of oil. Remember, back then the price of oil was over $100. 3,000 barrels, let's say, times 100, $4 a barrel on average. Guess the surprise this guy got, this guy's client, when he got an invoice that said, all right, you're long 3 contracts, you owe us $312,000, all right, and your 3,000 barrels are sitting in Cushing, Oklahoma. Come and get them. You got 3,000 barrels waiting in storage for you. Due bill of $312,000 USD. Come and pick them up. Every day you don't pick them up, there's a storage fee. Think about that. All right, well, what do you do? How do you get out of that situation, guys? Number 1, you panic. Number 2, what do you do? Look, you got long 3. Sell, exactly. Sell how many contracts? Sell 3 contracts. Write 3 futures. You hold the deliverable. You're good to go. In fact, there's a lot of companies doing it. Storage containers right now are cheap. Very, very cheap. Dry bulk and any kind of storage facilities at the moment, they're actually buying these ships, renting them, and floating them at sea as cheap storage. There's ships sitting there floating doing nothing. What do? They just pack those ships with oil. Imagine buying oil 5 months ago. Imagine 2 years ago when it was really expensive. If you filled that ship with oil and you filled it at 104 a barrel, well, now you're kind of screwed because if you want to go sell it, you're selling it lower. All right, so what I'm saying is whenever there's expectations of oil prices to go up, what they'll do is they'll buy oil containers, throw them on a ship, sell the futures 6 months out, let's say, if that's their expectation to go up, and when delivery comes, say, come and get my oil, I got it for you. and they make the price difference. This is the game that is played by some of the bigger players that produce and manufacture oil, the processing plants. We'll talk about this stuff. At the end of the day, we don't really care about all that. We just want to make money. But this is why you got to look at a futures market and ask yourself who's trading in it. It's not just you and me against each other. There's physical need for oil. CL, that's the commodity contracts. For every one contract you trade, that's 1,000 barrels of exposure. All right? That means that the minimum price fluctuation is 1 cent. For every 1 cent, that's $1. So think about this. What happens if oil goes up $1 a barrel? How much money have you made in your contract? If you own one contract, that's 1,000. Remember, always multiply it by the amount of units that contract puts you on the hook for. So if it goes up $1 times 1,000 barrels, you just made $1,000 bucks. All right? That's why these contracts are so freaking liquid, because people love them. They love them. You can make a ton of money trading oil. I'll tell you the nickname of the oil in the business. You guys know what the nickname of oil is? In the business, you tell this to anybody that's been trading futures for a long time. They don't know this terminology. It's the widow maker. Go figure why. It's the widow maker. This thing could definitely put some damage on you. So what's important here is risk management. So anyways, 1,000 barrels of oil, it trades in 1 cent increments. It trades from 6 p.m. to 5 p.m., all right, with a 60-minute break beginning at 5. So there's no silliness that it closes at 4:15 to 4:30 for maintenance, 4:30 to 5, reopens at 6. All you need to know is 6 p.m. to 5 p.m. 5 to 6 p.m. closed. 6 p.m. to the next day, 5 p.m. open. This happens on Sunday and finishes Friday at 5 p.m. Okay, so these markets are global. They're around the world, and that's why a lot of people trade them. Okay, futures are one of those things that most traders don't get introduced until it's too late. They'll try Forex. They'll try a whole bunch of other stuff, and by the time they run into futures, they'll say, "Oh crap! I wish I've been doing this the whole time." They're the simplest to trade. They're very liquid markets. All right, they're very transparent. For every contract that's traded, you're going to know about it. You could find out. You could even find out who trades it. Good luck finding that info on foreign exchange. Good luck. You could say, "Oh, look, the trend's going up," and then Deutsche Bank comes out with 500 million euro and just dumps it on your head. And who cares if the trend's going up and there's all these trend lines and RSIs and stuff? They have to sell 500 million for one of their corporate clients that wants to buy a jet in US dollars, and they have euro. Do they really give an S what's going on with the trend? No, dump my euro, buy the US, give me the price. They drop that on your head. There goes your stop. You can see all of that in futures. You can see every contract that trades is apparent. All right, oil deliverable. Here it is. If you want to trade anything else, you can go in here and look at agriculture, for example, and any other products. So your number one assignment for tonight is to find the product that you want to try to trade. All right, if it's futures on S&P 500 and oil, we got you covered, plus anything else that you want, and find out what the contract specs are. All right, if you want to do gold, GC. If you want to do silver, it's HG. Find out the symbol and the contract specs, when it trades. Know this like the back of your hand. So you're going to need to know it tomorrow. All right, back to the slides. Any questions? How are we doing? We're making pretty good progress here. Am I going too fast, too slow? Right pace. Got 100% or not attendance, but everyone's pretty much watching for the most part. Right pace. All right, good. Margin on futures. So guys, we know that we're going to talk about who actually trades them, all right, in terms of who the participants are, but us as the retail trader. I got to tell you something. No matter how much we like to believe we're professional, unless you're at an institution, you're still a retail. You can be a professional retail trader, but we're retail traders. What does that mean? We're the guys with the same seats, all right? No matter what I do, I can't get a better seat than you. I really hate when people say, "Oh, well, this guy's got better stuff." Well, you got access to it too. You just choose not to pay the fees to gain that advantage or that edge. All right, but we're retail traders. Let's see what it takes to trade these contracts. All right, if you think about it, to trade 100 shares of Apple at 114 is $14,000 or $11,400 at the 114 example. It takes a lot less to trade futures, but I want you to promise me and yourself something right now and say yes. Say it physically out loud as I say this and confirm it with you. Promise that you're going to trade responsibly out there, all right, and promise that you're not going to allow this thing to spin out of control, because in futures you could blow your account very quickly. There's a lot of margin. There's a lot of leverage. With great power comes great responsibility. Hate to be cheesy, but just because you got leverage doesn't mean you should use it. Now let's talk about margin. What is margin? Let me go back. What is margin? If I have $5,000, okay, in my cash account, and I'm able to buy a $50,000 stock, all right, this is the position. What's margin? Is it 5,000 or is it 45,000? Let's see. Who knows this? What's the margin? The amount of cash that you need to have or the amount that you're borrowing? I'm going to get you guys all on this. Margin is actually the amount of capital that you need to put down to open the trade. One of the biggest misconceptions, and like it's interesting because I'm with you. I know you've heard it differently out there, and to us we decide, hey, how much are we needing to borrow to take the transaction? It's not the money you borrow, it's actually the money that you need to put down in order to control the position. All right, so margin is the amount of your position size times what you got. Margin is a percentage of what you're contributing, basically. If you have a $1 million home, which I'm from Toronto, real estate, and $1 million will get you a rundown place. I can buy 1 million homes in Buffalo for $1 million. Well, no, I can't. But anyways, point is, $1 million bucks, and if I put a $50,000 down payment, it's not going to happen, by the way, but if I did, my margin is 5%. Cool? Capiche? All right. Very important to realize, because here's what we're going to do now. Here's S&P 500 futures contract. In order to own one, it depends. All right? It typically depends on each broker. So this is where it gets a little more interesting. There isn't really a finite answer, I can tell you. But look at this. Every S&P 500 E-mini futures contract that you're controlling is $50. Remember, 50 bucks, because it's $50 a point, times the price of the index. On November 23rd, when I did these slides, it's 2,200. Therefore, every one contract that you purchase on the S&P 500 gives you notional value exposure of $110,000. All right? But how much money do you need to have to buy one ES contract? Well, you don't need that much money. To control $110,000, your margin requirement is as little as, AMP Futures, which we're going to talk about in a second. It's an FCM and broker. Their maintenance margin is $4,750. Their day trading margin is only $400. Okay, we'll talk about what those two are and why they're important. But let's go back to this. With $400 of capital, you can control 110,000 notional value. All right, this is what's called, what we refer to as leverage in this business. All right, so what I'm going to say is this. Futures, anyone that I know that has made millions of dollars trading has done it with futures. You look at George Soros. You look at what Carl Icahn just did a couple of weeks ago when Trump won. He said he went home and bought $1 billion worth of stock. You think he went and bought $1 billion worth of Apple? No, he bought futures. You got exposure to the stocks. All right? What I'm saying here is you're playing with the big boys. It's low margin requirement, high leverage. Be very careful. All right? I want you to promise me that you're going to create rules and follow them. Say yes. Type it in right now. If you don't type it in, I'm right-clicking and kicking you out. No, I'm just kidding. I'm not going to do that. But you have to promise me because it's very important. Okay, good. Good. If you guys promise me that much, you're good to go. I promise you the best shot at success you're going to have if you just And I'm going to remember you said yes. I got screenshots. All right, let's continue here. So let's say we want to buy one futures contract in the E-minis, the ES. Well, how much is it going to cost us? As long as it's in the US cash session, it's only costing us $400. And it totally set. Our good friend here says, kick me out. I don't care. No promises. Look, you got to promise. I'm not kicking anyone out, but I know it's harder to do sometimes than to say it, but we got to do it with our best intention because we have to follow the rules. Without rules, we're going to get annihilated, and futures could be dangerous. All right, they can be really dangerous. So look, if we want to buy one S&P 500 contract, it means we need $400 margin. Let's say I buy one S&P 500 contract. All right, what happens is $400 gets taken out of my account. What is that? That's margin. Okay, at 3:59 p.m. 4 p.m. is what's referred to as the cash close. All right, so let's say at 4 p.m., how much money do you think I need to have? Does anyone know? Well, you now need $47.50. This is what's called maintenance margin. To maintain your position after the U.S. session ends, you need to pony up $4,750. That means if you have an account of $5K US and you're trading, let's say you have two contracts, all you need to have is $800 before 4 p.m. After 4 p.m., you need almost $9,000. You need more than $9,000. So what's going to happen here is it's called auto liquidate. They're going to force sell your trade. They're going to dump it on the 4 p.m. MOC is the terminology used, market on close. A lot of brokers will actually alert you. They'll say, hey, it's 355. You've got a position. You don't have enough margin to cover this position. We're going to sell. So they'll auto liquidate you. It's not a good thing. Even though they'll reduce that position for you, try not to let that happen. That's kind of like showing your broker you're irresponsible. It's like telling your kid, come back at 9 p.m. and they don't get back at 10 or 10:15 and say, sorry, they come home at 4 a.m. Well, we're going to have problems, right? So this is the difference. Day trade margin is the amount of money you have to put down to trade between the hours of 9:30 to 4 p.m. Eastern time. If you're in Chicago, 8:30 to 3 p.m. Eastern time. Once we go 1 second over, you now have to pony up 10 times as much in margin. So that brings us to the rule. This is why you need to have rules is, if you're down, don't average in. If you have a 5 contract position and it's gone down 5 points, don't buy another 5 hoping it'll go up to break even, because if you do that at 4 p.m., guess what happens? Every other sucker that did that, sell programs are going to come in, hammer this thing lower, rinse everybody out, and if you look at what happens in the markets, you'll see price go one way, 4 p.m. hits, and it'll oftentimes reverse. Don't believe me? Let's have a look at the markets right now. Let's look at the S&P 500 as we speak. All right, let me just duplicate the screen. Here it is. All right, everyone got long. Guess what happened? All day, the market's been going up. At 4 p.m., where is it? Right here. It's 2 p.m. actually. There it is, 3. At 4, actually, this was the opposite. They got squeezed to the upside. Yesterday, though, look at this. Yesterday, where's 4 p.m.? 3:30, 3:41. There it is, around 4 p.m. here. Everybody was short selling. What happens? Now, if you're short 2 contracts or 5 contracts, if you want to hold them, you got to pony up more money. You got to have a larger account to service that position. What does that mean? Close to 4 p.m., you're probably going to start buying it back to close your trade out. They bought it up. You see that? That pop? That's what happens. This is what margin requirements mean in the last hour. We'll talk about that a little bit more throughout the course, and I'll show it to you live as well. Let me see a question here that has just come in. Yes, as day traders, we are going to be closing. I do not hold positions overnight. All right? Day traders, I get into a trade, I'm in cash before 9:30, and by 4 p.m. I'm back to cash. What happens in between is profit or loss, but that resets for me every single day because I hold nothing overnight. Most prop trading companies won't let you hold nothing overnight either. Do they sell your position if you don't have the money? Yes. So let's say you have $5,000 and you have 5 contracts at 3:50 p.m. You only need $2,000 of margin to do that. So great. But at 4 p.m., when the margin requirements increase, you can only actually hold 1 contract. So what ends up being the order is sell 4 on close, and you're out. So you'll find yourself just being long 1. All right, on crude oil, no problem. On crude oil, the day trading margin's $1,000. Maintenance margin is $2,900. All right, so look at this. With $1,000, you can control 1,000 barrels. If price of oil goes up $1 with a $1,000 account, you can make $1,000. This is why when people say is day trading possible, and you tell your friend, hey, this guy that's teaching the course can make 5 to 10% return, sometimes daily, they'll say, no way, if he could do that and multiply it and dollar cost average and exponentially extend it out, he's going to have $1 trillion by the time he does that 31 days. Well, listen, buddy, nobody's saying that everything you make gets thrown back into your account. You're not doing 5 to 10% on everything you make. You gotta get paid, right? You gotta pay yourself. Right? You gotta pay yourself. So out of that has to come your paycheck. Anywho, rant over. E-mini futures, 47.50 maintenance margin, 400 day trade margin. This is with AMP. With other brokers like IB, Interactive Brokers, another real big platform that allows futures trading. I would never trade in futures with Interactive Brokers, never again. I was there, and I never made money trading until I moved out of IB. I'll explain why in a second. All right, here's their margin. So if you're there at the moment, intraday you need $2,300. So as you can see, their margin requirements are higher because you need to put more out of your own money. Overnight initial, you need $6,800, and then $47.50 to maintain that position. All right, so they require a lot more capital to trade futures, Interactive Brokers, than most other brokers. All right, so what I'm going to tell you guys, live by leverage, die by leverage. With an AMP futures account with $10,000 US, you could buy or sell 25,000 or 25 ES contracts, which means what? It means that with a $10,000 account, 1 point move could make you $1,250. I'd never recommend that, ever. 25 is a lot more size than most people will trade. I would assume that most of you here will trade 2 to 3 contracts, maybe even 4 on the higher end, and that's a good start. Don't trade more than 3 at the beginning if you've never traded it. Try to trade more than 1. All right? It's not as dangerous. You'll see it's not as dangerous if you have good risk management. In fact, it allows you to lose less. Try to trade more than 1 so you can get out. If you have a position and it's gone up a little bit, it allows you to sell 1 to get out and lock a profit. And if the other one goes down, then break even. So it allows you to keep more money. I think the biggest problem with traders is they start trading with just 1 contract and they learn bad behaviors with just 1 contract. Number 1, it's small enough size that, hey, you know what? If it goes down, who cares? I'll just buy another one. I'll add 1 more. I'll add 1 more. And that teaches you a terrible, terrible idea of a strategy. That's the first thing it does. The second thing it does is doesn't allow you to add in or get out of profitable trades. It mostly teaches you how to get into losing trades. You ain't getting into losing trades, right? Demo account. Sorry, what in terms of demo account? If AMP Futures has a demo account, they don't. They really don't. We'll talk about demo trading and how you can do it. All right. We're getting to that in a second, actually. If you have a $10,000 US account and buy 25 contracts, in 8 points, you're going to lose your entire account balance. That's why it's so deadly, okay? So that's why I made you guys promise me. Never max your leverage and never martingale your way out of trouble. You got to respect leverage. Who knows what martingale is? And if you do, the second question is, do you use it? So if you know what it is, just put 1 Y. If you use it, do 2 Ys. Or if you have used it in the past. When I was learning to trade futures way back in the day, I followed a guy, not naming any names for anyone, started with 5 futures long ES. Yeah, exactly, adding to losers basically. Started with 5 contracts ES. And the price, I saw the price go down. He had another 5. He had 10. And through the course of the morning trading session, he was at 48 contracts long. All right. And I said to myself, well, great, this guy's going to eventually break even if it goes up. His statistics were saying that out of 200 trading days, he's only had 1 negative trading day. That one last year. Does that make you guys nervous? Let me give you some more stats. It's interesting. I'm going to martingale my way out of anything. Eventually, I'm going to break even. Then I saw the day, and I'm not mentioning who it is or what day or what happened. He started with 5 contracts, and by 3 p.m., he was 912 contracts long. I'm not kidding here on the ES. Yes, he had money in that account. All right? But remember, here's what nobody tells you about averaging into losers. If price goes down, oh, I'll just buy more. Oh, I'll just buy more. You're not buying an asset that's guaranteed to appreciate. You might buy it. Remember, these things expire every 3 months. You might be buying the high of that 3-month period, even if you can afford to wait. Even if you can afford to cover the margin overnight. Even if you have $30 million and you covered your margin. Nobody's guaranteeing you that you're buying a lower point because these things expire every 3 months. And if you martingale your way into it, what ended up happening anyways, make a long story short, this guy got, his broker said you have 912 contracts. That's a way too big of a position. We're selling you out of it. And they crystallized him a loss that it took him 200 days to make. All right? 199 days, you're having a phenomenal year, and the one day you lost everything you've made in the past year. How do you think that feels? How do you think that feels? You're back at a trader. You got $1 million and you want to give it to one trader. And a guy shows you that statement. Do you give him the money to trade it for you? I had a friend, runs a prop shop, and he said it the best. He said, martingale with your own effing money. That was his quote. You ain't doing it with mine. Basically, what I'm saying is don't add to losers. There's a time and a place for it. Okay, we're going to talk about it, but it doesn't always come back. And that's what I want to tell you. The number one source of blown trading accounts comes from leverage into losers. All right, that's why I made you promise me to follow the rules. If you follow the rules I give you throughout this course, that will never happen to you because you understand the math. If you, based on a certain percentage, if you lose this, now you got less. Well, a percentage is a smaller amount of this than it was of the bigger account balance. All right, the sad truth is if you lose 50% of your account balance, you have to make 100% to get back your loss. If you lose half, you got to double to get back to break even. All right. Made you guys promise me. Most of you took the pledge. I have to give you that word of caution and warning because I'm serious about this. You want to lose everything you got? Forget the rules. Start buying the dips. It's a dip. I'm going to buy. I'm going to buy more. I'm going to buy more. And if you see me do this in the live trading, if you see me add to a loser as it keeps going down and add again, I give you permission to slap me. I don't know if I'm going to. I've done it occasionally. I will occasionally do it. But there's parameters. We'll say, all right, I'm going to average in, well, what happened here? I average in 4 ticks is all I got. Put my stop, that's it. Only losers add to losers. All right, here's the thing. We suggest 1 contract for every $2,500 US capital. I said you should trade at least 2, but no more than 3 or 4. So if you're listening to this, you need a 5K account minimum, and anything more is great. And you should do fine trading 2 contracts with the rules that we're going to put in place over the next 7 lessons. All right, here's the commissions, and we're going to look at software, and then we're going to call it night, and I'll open up for some questions, by the way. All right, commissions vary by futures or by country. My rule of thumb is you should aim to pay no more than $5 US round trip per contract. That means to buy 1 contract and to sell 1 contract, you shouldn't be paying more than $5. Broker charges you $9.99 flat fee. Change your broker. And I'll talk to you guys about some good brokers in just 1 second. Do I even want to cover this? I kind of already explained it. Look, you want to buy a contract, somebody wants to sell it, it goes through the FCM or the broker, that broker sends it to the market, the transaction's made, and then the client receives that on their report. Okay, so this is how the market works. Like I said, it's centralized. The order flow happens automated. You don't have to worry about finding a seller or a buyer or a counterparty. You just need to do the trade. Okay, here's the players. There's two types of participants, speculative and non-spec. Okay. The difference is, and the third one I forgot, liquidity providers. The difference is speculative traders are institutional managers. Okay, these are called your asset managers. These are hedge funds. Okay, they're mutual funds, pension funds, endowment funds, sovereign funds, proprietary traders. All these guys are institutional, and that doesn't mean they're crazy. It means they're speculative. It means that what they're trying to do is speculate. They're trying to guess direction and make money. Now, if a hedge fund is long, does that mean they're buying futures? Or not? Well, not necessarily, right? If they're long, let's say 500 companies and their portfolio models the S&P 500, then maybe they're selling futures for downside protection, just to hedge. That's, after all, they're hedge funds. All right, some mutual funds will say, hey, we got this tactical asset allocation fund that seeks to find value and invest in it by blah, blah, blah. We'll talk your ear off. Go to the bank, your financial advisor will give you the spiel about mutual funds. What do these guys do? They take your cash and they throw it on the market and they bet upwards, and that's it. It's called closet indexing. They'll just buy the index. So basically, all these institutions are out there trading S&P 500 futures. These are called speculative traders. They speculate. And there's us, you and me, and everyone else in this webinar, the retail speculative traders. All right, the non-speculative participants are the ones that nobody thinks of when they trade. Everyone gets that hedge funds want to make money, so they buy or sell futures depending on where they think the market's going to go. But then when you look at the non-specs...
And there you have it. I hope you guys enjoyed today's video. We showed you what futures are about and a small introduction. In the Day Trader Pro package, you will have access to 10 full lessons explaining how order flow works, how to find trading zones, including our trading zone locator cheat sheet that allows you to find levels at which there's high probability, low risk trades throughout the rest of the session. Also, you get 5 checklists to help you identify the 5 different trade types in the market that'll help you make money in slow and or trending markets. Plus, you get a live daily trading room every single morning where you trade with the entire community and you earn as you learn. So go ahead and hit the link in the description and check out more, and we'd love to have you on board. Plus, it comes with a 14-day money-back guarantee. So this is the only time in the markets you get to try something risk-free. We'll see you guys in our live trading room. Thanks a bunch for tuning in. Please like, comment, share, subscribe, and I'll see you guys at the next video. Thanks so much. Take care, manage your risk, and trade like a trade pro. Goodbye.